Welcome to Ask the Experts. It's the Tri-City Regional Chambers series to help business leaders grow their companies with practical advice and answers that you can implement right away. And again, special welcome to you Zoomers out there. You're a valuable part of our audience today. And hello to those watching the recording on YouTube. My name is Paul Casey. I'm the Executive Director at Leadership Tri-Cities, and I'm privileged to be your facilitator today. This is a free benefit of your chamber membership, and it wouldn't be possible without the generous sponsorship of STCU. With us today is Charlie. Charlie, come on up here. Give the crowd a welcome.
So, real quick, Charlie Grader, Director of Commercial Banking at STCU. Thank you to Paul and the Chamber for continuing to host these events. Thank you to the audience for being here, and most importantly, thank you to our experts. Look forward to the presentation.
Thank you again for your leadership or your support of this leadership development. So for approximately half of our 90 minutes together, our experts will be presenting their gold nuggets on our topic of leveling up your business. And then for the second half, they will answer your questions. If you'd like to ask a question, and we do encourage everyone here to think of one question. Okay, even if you're an introvert, we're giving you a 45-minute warning to think of a question. Okay, you are, whether you're virtual or here in the room, so you can just raise your hand if you're here in the room. If you're on Zoom, go ahead and put it in the chat. And there's my cell phone number if you want to stay anonymous. And I'll look at it and vet the questions that way. You never know, people are like, my boss might hear that. Okay. And then these guys will have their contact information available afterward if you want to follow up with them following the session. So again, think of that question along the way because we'll be hitting a multiplicity of topics today. So Kyle was a last minute, like an hour ago, said yes to this because our other speaker couldn't come. So Josh is well prepared. Kyle is like, I'm going to make this happen. So we do really appreciate you, Kyle,
what he said,
from coming in. And so we're going to let them introduce themselves today. So again, welcome Josh and Kyle.
Thank you guys for having us. So I'm Josh Bam with Albatross GC, General Counsel Law Firm. We like to just be kind of responsive to clients, try to make bills predictable, which is bizarre. So we don't invoice for everything, which is really nice. But I mostly work on mergers and acquisitions, on real estate syndications, contracting, some of that with government. I work with a client right now in Seattle who works with the Attorney General's office and SDOT and Seattle Lights and all the fun organizations. And I was lucky enough to meet Kyle at the Rotary, at Columbia Center Rotary, many years ago, pre-COVID, if you can believe that. And Kyle was nice enough an hour ago to say, yeah, I would love to come to your presentation. And I said, well, you're going to present with me, right? And he said, you know what, I will today. And so thank you for coming, Kyle. If you'd like to do a little bit about yourself.
Yeah, I think it was an hour and 20 minutes ago, exact. My phone rang and it was Josh, and of course I'm going to answer that call every time. But I'm Kyle Edberg. I'm the CPA. I own my own practice, Edberg CPA. I've been in public accounting for over 31 years now, so I've been at this for a while. I'm a solo practitioner now. I've worked for different firms in Seattle and the Tri-Cities of different sizes and different expertises. And I focus mostly on tax compliance and tax planning for people. I get involved in business transitions and estate planning as well. I have done some expert witness work over the years as well, and divorce and real estate and business matters. And so I've seen a lot of things over the years. So
yeah, so
happy to be here.
We've been able to work together on past projects, including some forensic accounting projects, which are always really exciting. I love uncovering those little nuggets. But then we've also been able to work on much more exciting projects like just filing taxes and, solo 401ks recently. So that's been really fun. So today, we're just going to chat a little bit about growing your business. The elections are over. I think we can see what the economy is going to do. And so at least for a lot of my clients, we are adding locations. We're adding brewery locations. We're adding food truck locations. We're buying real estate. We're adding like research and development projects. And so, we're saving some cash just in case. but we're sort of getting ready to spool up, I think. That's how 2025 feels to us, at least. Is that fair?
Yeah, I think so. I've seen people that are slowing down and, you know, the interest rates finally are starting to come down. I've seen people put the brakes on when rates are real high. In some ways make smart decisions like, okay, it's time to quit paying on this high interest variable rate debt. And I've seen some people make wise decisions. My hope is that some of that will loosen up and, you know, allow some people to start expanding again.
Yeah, I think that's fair. I think that's everyone's hope. So, definitely questions are encouraged. If you want to talk about something or you have tips or advice on something, let us know as well. This is not George. This is still Kyle. So sorry for the clarification there. And we'll just move right on.
If you came to see George,
That's George's logo, so we'll reserve all rights to George, and Kyle has his own logo on his business card, which he can totally show you.
an hour, he needed more than an hour. I tried.
So for our agenda today, we wanted to just touch on a couple of items that I think we see a lot. And at least some of the questions that I get a lot, and maybe Kyle gets a lot. But I think we'll defer to him on some of these items as well. So this is our basic agenda for today. We'll sort of start at the top and go down, but seriously, if you have anything or there's something specific that you're doing and want to know, interject, or you can save it for later as well, if that's useful. So the first one I think we wanted to start with was just some of the L&I and registration matters. So we'll go over tax and some of the employment stuff, but now at least for 2025, I'm seeing some people add locations, but also adding employees. So maybe this is something you've already done, but if you are setting up employees, this is sort of a checklist of what comes next. The bottom part is what I spend most of my days talking about, and writing about and drafting around. So in terms of just setting up employees, maybe Kyle, if you want to talk to what it looks like, but you always start with the Department of Revenue. You'll go to the Department of Revenue, update your license and say, I'm going to have employees. You'll talk about how many employees you have. That's at the state level. Then you might have to do that again on a local level, like in Montlake Terrace, for example. And you may have to pay taxes on how many employees you have in some places like Kirkland. And then there's, you know, L&I gets triggered and there's another process, and you probably see a lot more.
Yeah, I don't get involved in the setup as much, but you do see this come up and, you know, keeping in touch with the Department of Revenue. They're actually pretty helpful if there's some filing that you're supposed to do that you're not doing. I found them pretty easy to reach out to over the phone and say, hey, what license am I supposed to get? Sometimes people like myself can talk to you about what you're up to, determine if you need a city license or different things. You know, I look at it case by case and decide, hey, what do you have going on? I see a few others coming in late, so.
So on the Department of Revenue side, you can apply for your state license. Sometimes you can add a local license. Otherwise, you have to go through File Local and get a local license, like in the city of Seattle, unfortunately.
Yeah.
And the city of Seattle has a bunch of other timekeeping requirements as well. So, you know, going through this process, if you're going to set up a company, maybe it takes 2 to 3 weeks to set up a company. But then going through this process alone usually takes about 2 to 3 weeks, because once L&I is triggered, you got to get your unemployment rates, you got to set up your accounts, you got to set up your ESD account to actually go pay all of that stuff with the state. You got to set up your EFTPS account, I think is what it is for your federal side, to go pay your federal employment taxes. So, I mean, it's quite a process, but
I know there's a few people that do payroll work and bookkeeping work. You're probably really good at that. They probably do more of it than we do.
yep, that's probably.
They're
fair.
smiling. I think that's a yes.
So you can see that there's a lot of things that are triggered here. And so if you have employees, it's something you just have to go through. But if you're working on your own and you're making substantial amounts of money, you may want to elect S Corp taxation, which we'll talk about in a second. And then you will have to go do these things for yourself and pay your own employment taxes. So to some extent, you can write them off and not include other income as self-employment. We'll talk about that too, but this could be, you know, all of this reporting just for you if S Corp makes sense. And then of course we have benefits. If you're gonna have employees, Sometimes they want benefits. You don't have to offer benefits, of course, but if you do offer benefits, it has to be consistent across the board for everybody in that class. So you can't say, you get really good benefits and my benefits are terrible, but we work the same position. That would be discrimination, and IRS does not like that. But there are some benefits that are outside of the normal things, right? Like reimbursing for healthcare and those kinds of things. There's HRAs, which are not like HSAs, but just kind of reimburse employees for their healthcare expenses. And so if you're a smaller employer, there's options there that could help you write some of that stuff off for tax purposes, but also not pay like big employer on the market prices for plans.
Yes.
So I think, when you take that step to get employees, or once you get past, I would say 8 employees, it's time to just look and see if everything here is up to date. You've registered all of them with DSHS. But then on the back end, if you have, do you need standard operating procedures or employment manuals? What happens if somebody comes to work and is drunk? Do you want to just cover that? What about domestic violence? What about jury duty? And so having employee handbooks to some extent, when you get to 8 or more employees, I think is useful. If you're doing dangerous stuff like climbing on roofs, cooking in kitchens, and I would say it would be useful to have a manual and some kind of standard operating procedures beforehand. Because, that's going to say, look, if you hurt yourself or you're injured or something, did you follow these procedures? Were you doing all the right things as we go and file for workers' compensation claims? So just the standard I like to look at is about 8 employees. The part that I spend my time thinking and talking about is this person a contractor or an employee? And so in Washington State, LNI sort of has a test for if they're going to be a contractor or an employee. Most of the time, they look at this 6 or 7 part test. And so for contractors, for construction workers, it's 7 parts. For everybody else, it's 6 parts. And it includes things like, do you exercise control over the employee? Do you direct them? That would mean, do you tell them when to show up for work? Do you tell them when to leave? Do you give them the projects and tell them how to do the projects? Do you give them software? Do you give them equipment to use while they're at work? So if you fail any parts of these tests, you're not a contractor, you're an employee. Some of the other things are, do they have a separate business license? I think that's part 5. And so I was able to work with a company not too long ago, and they were hiring out like nurse practitioners. And so those nurse practitioners were contractors. And when L&I came in, they basically, the first question they asked were, did these people have business licenses? That was the determinative factor. That's all they really asked. And if the answer was no, then that's it. They're not contractors, they're employees. Then that means you go and pay taxes for that person from when they started working until present, because you got to cover all those employment taxes. And so that could not be very fun if it's been a few years. So in Seattle, we talk about focus groups. If somebody comes to a focus group for, Puget Sound Light, Puget Sound Energy, and they're going to talk about what the Puget Sound Energy projects they want to be, can we pay them as a contractor when we're telling them where to show up, when to show up, we're directing the meetings, they clearly don't have business licenses. And so how can we make these people contractors and not have to hire them as employees because they're not employees? And so there are ways to look at that. There's a personal labor test. You'll have to look at if they are providing services that are similar to the organization, similar to what the organization already provides. But it's a pretty extensive analysis. And unfortunately, if you get it wrong, it's expensive.
Mm-hmm.
Have you seen anybody get it wrong?
Not on my watch. It seems like there's usually an agreement between both parties that I've seen as far as how somebody's going to be treated, but I've heard of it largely in the tech industry. And guess where? Seattle, when somebody gets too aggressive and calling somebody a contractor and there's a dispute, and then you go into these tests and you kind of end up with whatever findings they get, and it's expensive and messy to unwind it and pay all those taxes.
Yeah, that is true. So Department of Revenue and L&I might be forgiving on some of the late fees and stuff. When it comes to classification of employees, they're very aggressive.
Yeah.
And very employee focused. So if you get into sort of like that dispute in the L&I channel, I would say get an attorney for sure. Because there's definitely ways to handle it and factors that they're looking for specifically. So, anything else you want to add about employees?
You know, where I see it more is at the federal level, and industry standard is sometimes what you go by, but same thing, if you say you're one and you have to switch it to an employee, there's payroll taxes. And the federal government's pretty aggressive about wanting things like 941 taxes paid. They'll come and get you.
Yeah, that's true. And for, you know, filing a lot of those loans and stuff, you need all your 941s up to date and, yeah.
Mending those things is a pain.
Yeah, on the employment side, you know, I think tracking hours is very important, just because you're gonna try and build a case to prevent disputes. Keep an employment file, even if it's your best friend, or your grandmother, or whatever it may be. Like, if stuff happens and people are late, or there's issues, just keep it in the file, because you never know when you might need that when something happens down the road. So just keeping a full file is super useful. And then, you know, in terms of like the claims process on the L&I side, that's all generally letter writing, and they go do hearings and stuff. So if you are finding yourself that you've like fired an employee, or an employee is mad at you, or if they threatened to take you to L&I, and this has happened, what, 2 weeks ago. We had a chef in Seattle who was sexually harassing employees, but nobody wrote anything down in the employee file. And then the employee left, and he said, "You messed up. You technically owe me a bunch of back wages." And so now he threatened to go file a claim with L&I. And it's random stuff, and none of it makes sense. But if he did go file that claim with L&I, and it met their face specifications, they would accept the claim, you would have to respond. If the response wasn't good enough, you would have to have a hearing. So even if it's a baseless claim, it could still start a process, which is not fun. So if you're firing employees, or you know, if somebody's resigning or something, you know, I always like the performance improvement plan. I know it takes 90 days to like terminate somebody, but if you can put a performance improvement plan in place and say, you know, you didn't meet the standards in the plan, and so this is why we're terminating you, that adds a lot of strength to your employment file as well. Or if somebody's leaving or is mad at you and you can settle that and get a true settlement, you can't settle all the claims like with the National Relations Board. But for unionization, right, you can't settle everything. But you can settle a lot of things like age and discrimination and wage complaints. Even if you allow them to also go file for unemployment, if you can get a settlement, that's definitely worth it. It just closes the door, which I think is really nice. So do you get to see a lot of tips reporting? Because that's been kind of a subject of contention lately.
Yeah, it's being talked about. You know, I see it when you've got people in the restaurant industry where tips are a normal thing. You know, I don't do a lot of payroll work myself, but you do have to classify them and be real strict about it.
Yep, and I think you gotta keep that, those tip accounts separate, and the owner can't take. And do you guys get to report a lot of tips? Do you see that a lot? I know some of
We
those.
do tips a little bit, and it's something that we're always circling back to and never. It's always changing, we don't ever feel really great about it, but, we generally, if we see tips, they pay them out as credit card tips paid. So
Yeah.
that they're accounted for, that's what we encourage.
Yeah, I think that's the right way to do it, because you gotta get that journal entry, like you have to get the mark somewhere.
Yeah, and then it's important that managers not take tips, and that there's, another big thing we see is tip pooling.
Yeah, that's right.
There's been some,
I think some recent changes with the tip pooling have had a few people in the restaurant industry completely switch how they do it, because the way they were doing it prior, I think, was starting to get flagged. People were getting more than they should have, and.
Yeah, that's
Yeah.
right. And that creates a larger audit risk too, when the IRS is just giving you points. So you wanna have that on lock for sure.
You didn't know we were gonna go for audience participation.
Is there a consensus on tips and tip pooling? Because I heard it all over the board.
Yeah,
Is there a consensus, or is it just we're doing the best we can?
Well, I mean, I think it's gonna be based on like what system you have and like who's, like where you're pulling in the actual tip numbers from. But like having an actual like entry for credit card tips definitely is the best practice. I don't know about tip pooling. I know that's a preference in the restaurant industry. But I don't think, I mean, do you guys like tip pooling?
But it's harder to manage it pulling.
Yeah,
It's more work.
it feels like it's administratively burdensome and you can't tell if the end result is right or not.
It's difficult, I'm sorry. It's difficult when people in a coffee shop, let's say there's one person opening, that's clear they get the tips. So they've worked for 2 hours and then their second opener comes in, and at that point, does this person tip out everything, take the tips collected so far, and now at that point, is it a 50-50 split until which time that third person leaves and this person, so in a fast-paced restaurant environment, it's not actually, you're not able to stop the presses and count the tips and then move on about your day, so in practice,
That's right.
it's really difficult, but in theory, there's an honorable way to do it in the pool process, but I don't know that it's 100% approved. So like in our business, which is closing, so no audits, please, but
Depends who's watching.
we would have meeting after meeting with our team and try to decide as a unit, what is the best way to do this in a fair, equitable way.
Yeah.
And got to this sort of thing that I think is in line with the policy, which changes all the time, but
Yeah.
where basically a percentage of your hours worked on payroll is that percentage of the tip pool. So that's sort of paid out in either if you're paid biweekly or semi-monthly. So if the cumulative payroll was 500 hours and this person worked 50 of those hours, they would get 10% of the tip pool for that payroll. Seem to be the fairest way, unless of course Susie walks in and says, you made my day, here's $100 bill. There's exceptions in that regard, but generally it's a quick 10% and there's not really, sometimes there's not service associated with the tip per se.
Just pro rata.
Yeah,
Yeah, I think that's really the issue is like, it's the practical side on the restaurant side where versus how we're reporting it, right? But I think so long as you're doing it consistently, I think that's the right way to do it. Once you start changing those things, then you're gonna get looked at. Is that fair? Yeah,
Can you review what tips are subject to all the payroll taxes? I've heard different things, well, you don't have to pay tax on tips for this tax, but you do on that tax, and how's that work?
yeah,
like cash or card, I think is
The
the
credit card.
distinction on the streets, but we don't know if that's a legit way to look at it.
I don't know if that, I think that's why we're trying to make everything credit card entries too. But do you guys want to talk to like the payroll taxes? Cause I mean, we're adding it all like as actual entries.
Yeah, it's supposed to be income unless you've got a specific legal exception that says it's not. Now, you say on the street, if there's a cash tip that doesn't get caught, that's hard to capture. But if it's something like credit card receipts where it's in the
Yeah.
system, I mean, it's being talked about with our, president-elect, but that's taxable income and it is subject to the Social Security, Medicare, payroll taxes.
What about, unemployment? ESD, is it included in?
Employment security?
I
Pardon?
think,
No, employment security, the state tax.
Yeah.
Yeah.
Are tips included in the salary that you pay tax on for that tax?
Yeah.
Okay.
I see nodding
heard it
heads
both
out there,
ways
so
from
yes.
accountants and things, so.
My understanding is that it's part of the gross salary, so it's
That's
just
right.
effective down the
and
line.
it's on the W-2 in a specific box, that's, yeah. It should be, and that's the issue with cash tips, I think, is that it's often not. But it should be, and employees should want that stuff, because if something happens to them and they need that insurance or social security, they want like all the earnings that they have properly reported. Hopefully,
Ish.
yes, mostly. So, in terms of the Department of Revenue stuff, just like, the first box really is just normal reporting stuff. It's supposed to be that we don't have a business income tax, but business and occupation feels a lot like it.
Yes, it does.
It's oddly based on your income, so. Very bizarre. And there's not really a lot of exemptions. There's a small business tax credit. But it's not like the federal side where if you file an 1120S, you can take some stuff, you just pay gross.
It's on gross receipts.
Yeah, so, but then also I wanted to, at least before the end of the year, just talk about some of the annual filings that we do that to some extent you want to have automated. Which is an annual report, right? Business entities need an annual report every year. That's easy stuff. License renewals, you want to be able to automate that, hopefully with like a CPA or somebody in your organization that just has access to that account. Because if you open other locations and stuff, you basically want one or two people, you want to have that information available just in case something happens to them, that have access to those accounts, so everything's in one place. And so for the licenses, Department of Revenue, you'll have to just file like bond and stuff updates with L&I if you're a contractor. You know, there's a health renewals there, health inspections. If you have like scales and stuff, they'll come check your scales if you're selling wholesale coffee beans. And there's state licenses or this local licenses. And so each one's different. Montlake is different than Bellevue, than Kirkland, than Seattle, than Kennewick, than Richland. It's magical. You have to file in all of them where you do business. And it seems like everyone wants to stop you from doing business, but don't, keep going. It's worth it. Wow. That's why to some extent, you know, like with the employee filings and, you know, if you're gonna go do this stuff by yourself, it can seem daunting. I want to automate as much of this stuff as possible so that you can go do other things and as cheaply as possible. The other one that's due before the end of the year is the beneficial ownership report. That's with FinCEN, Department of Treasury. You just have to file with all the owners' information. In Washington State, we're community property, so you probably have to file, you do have to file with your spouse's information too. Unless there's some other writing there, some like buy, sell, or something there that you can show that that spouse is really not gonna get ownership, a prenuptial agreement or something. Otherwise, you gotta go file because that spouse is a potential owner as well. Even if you're the only one listed on Department of Revenue or Secretary of State.
And that's a new filing. That's not something that's been out there for years and years. It's really kind of a nuisance. I know some people had hoped it would go away. There were some court cases challenging it that haven't stood up, and I haven't heard anything about an extension. So right now, existing businesses have till the end of the year to get that filing done. You can do it online really pretty easily. New businesses have to do it within what, 90 days or is it
30 days.
30 days, okay, so.
And then amendments in 30 days.
Yeah, but it's not something you have to, it's not an annual filing unless there's a change.
And it's free. So if someone's trying to charge you $1,000 for a BOI report, don't pay that. Just go file it free. Just in case, because man, there's so many scam letters about trademarks and about annual reports and all these things going around, and they've gotten really good. So if you've gotten a letter that's like, we'll file this report for you for $1,000, don't do it. Just full disclosure. Yes, sir.
Can I ask a question about the BOI filings? So I interact very frequently with a company that's based out of the UK. They've got a company established in Washington as a subsidiary, but it's owned by another company based out of the UK. Given the fact that the UK is community property as well, does the owner of the parent company need to provide his wife's information?
Yes, sir. I think that would be correct. And it would be by passport in that case.
Thank you.
No, not a good question. And so that database is not a public database yet. You can't just like Google people who filed, which would be, I think, not a good use of it. And hopefully it doesn't ever become public. They're talking about it, but it shouldn't be a public database. But what they're trying to do basically is just capture everybody who's doing business in the US, because for a long time, we were the best place for fraud, for money laundering, because I mean, I can show you how to go create a Wyoming or a Nevada entity that doesn't have a name and we can route it offshore. And you can sort of get a debit card for the Caymans, right? And that's not good. That's not really what we want. And so I think this is. Yeah, well, that's fair, actually.
Edit that from the video.
But I think this is really aimed at just preventing some of the bad things, that go on in the business side. So there are exemptions, like, if you have a nonprofit, or like there's nonprofit hybrid structures that operate a for-profit subsidiary. Those guys, still nonprofit owners, they don't have to file.
Trusts do not have to file.
Yeah, if you're not doing any business with it, you should close it down, but you don't have to file. So just full disclosure. Oh, one last note on employees, and then we'll move on. If you are having a rough time in your business and you're like, I am gonna stop paying things that I don't wanna pay. Because I need to save cash flow and maybe I'll do it later or maybe I won't. You can stop paying a lot of things. Maybe like credit cards and those kinds of things. Don't stop paying things with personal guarantees. But especially don't stop paying employment taxes because that is a personal liability. If you don't pay your actual employment taxes, they'll do fees and a bunch of stuff on the back end. But if you don't pay that employment taxes, that will follow you personally wherever you go. And you will have to pay that. And so you try and pay that off first and then settle the rest of the fees, but that is not negotiable. They do not settle the employment tax portion. Just full disclosure. If your landlord doesn't get paid, I mean, whatever, but the IRS will track you down for this one, unfortunately.
You're talking about, they could come after, like a sole proprietor that.
Anybody, any of our owners, if you're a corp and you have personal tax liability, like you didn't pay your employees, they will track the owners down with their socials and try to get that
And
money
get them personally.
for Medicare and Social Security.
Use them.
Specifically like 941s.
Yeah, that style, yes, sir.
If you hear the term trust fund recovery penalty, that's what they're talking about, and they will come after you as, you know, a business owner or even somebody with payroll responsibility as a responsible person. Because really, if you're withholding somebody else's payroll taxes and then not remitting them, you're stealing. And that's the position they will take.
Does it flirt with a criminal?
Yes, there could be criminal penalties if you don't negotiate with them, if you just are non-responsive, they could.
Yeah, this is the IRS you're dealing with. They have the power to get nasty if you do not respond to them. I have seen it where clients are behind on payroll taxes and not responding. I had one client where magically they went in and cleaned out his bank account. They can do that. It's not to be messed with.
These are the IRS agents that come with like pistols. Like these are the enforcement. I've only seen that one time. It's for a mall in like San Antonio.
I've never seen one with a pistol. The people that do that kind of work know what they are doing and they're smart. They know how to get work done.
Specific question from Zoom. Is there an exemption for tribal members for federal unemployment form 940? Nobody know?
For, as a business owner,
Is there exemption for tribal members for federal unemployment form 940?
if you're doing business in the US and you have like US employees and stuff,
As a business owner, yeah.
then you would need to file that form. If your form is, if your business is solely on tribal land, that could be different.
Yeah.
But if you have like US employees and regular people and it's not on tribal lands, you're gonna have to comply with all the federal filings, unfortunately. And if it's on tribal land, you know, you may not, if it's like a special kind of business, you may not be able to go through like the ordinary business entities like LLC and stuff either. And so we would just go talk to a tribal.
Yeah, you want to go get an expert in dealing with tribal stuff.
It is on tribal land.
Yeah, so that could be very different.
Okay,
Absolutely. And if they want to reach out, I can totally connect them.
okay,
No issue there either.
thank you.
Yes, sir.
With the trust fund recovery, another issue is that the employees get hit because the employees will get hit too, because they don't have any deposits to the IRS, right? So when they file their taxes, it doesn't show that they paid any taxes.
Yeah.
That's right. Yeah.
Bad news.
Man, you know, yeah, I think that's the one that gets me the most.
Yeah.
The personal guarantees, you know, you can sort of bankruptcy around a lot of stuff if you really need to. Where you can create settlement like payments for things, but that one I think is really pretty strict. So, any other thoughts on that?
No.
So just to move on here, like, in terms of structuring businesses, because now we're getting to the end of the year and everyone's like, oh, actually, I needed to do these 8 things. Can you help me in the next 40 days? So, I think there's a few types of entities, that you can get. You can be a sole proprietor, you can be an LLC, a partnership, a bunch of things. There's a bunch of, those are disregarded entities, right? All the income and all the tax and stuff is paid by you personally. And then there's S Corp taxation, which is just a tax status. That's a limited liability company that's made an S Corp election with the IRS. And all that does is allow you to deduct your salary, to some extent, and then take the rest of the income as ordinary income. So long as your salary is reasonable. Always recommend like a reasonable compensation study just to make sure. And these guys can totally help with that. But I think that's important if you're gonna go back up that compensation with the IRS. And then if you're an S Corp, you should, if you're gonna go use like your phone or a room in your house for business, you need an accountable plan as well. And so just making sure you have all those pieces in place, I think is useful. So if you're making, $60,000 a year and, maybe $20,000 is expenses, I don't think you need to go make an S Corp election and pay all of that stuff and register with ESD and ALANA and, go pay the federal government for employment taxes. I don't think it gets you anywhere. But if you're starting to make maybe $120,000 a year, and you can add some of those things in, then I think, you can take a salary of 60, and that's reasonable. You can start to see some tax savings and you can build a W-2 paper trail, which I really, really like.
What I normally tell people when they start talking to me about S-election, everybody likes, oh, I can save on employment taxes by paying myself a salary instead of being self-employed and paying self-employment tax on everything. I always tell people they've got to be careful there. One, if you're not making any money in S corporation, they're going to save you any taxes.
Yeah.
You're just creating an administrative burden for yourself. Two, you have to do payroll for employees, even if it's just you. Now, if you have other employees, you're already doing payroll. It's not that hard to add yourself to existing payroll processing. But if you're a single person shop and you're the only employee, that's more administrative stuff that you have to do. So the practical question is you have to figure out how much tax you're saving by electing an S corporation versus being a sole proprietor or partnership, depending on how many owners you have. And is that tax savings more than the administrative hassle you have to have being an S corporation? Because an S corporation's got to file a separate business tax return. Self-employed person that isn't has to file a Schedule C as part of their 1040, which is a simpler filing. So there's more time for people like me if you make that election. So there has to be some tax savings for other business reasons to make it make sense.
Yeah, and I think it has to be an operating business. Don't want to hold real estate in an S corp because losses are limited. And you don't want to you can't have a bunch of shareholders in an S corp because it's one class of units. You can have non-voting or voting units, but you can't say, you get a little bit and I get a little bit and I get voting and my class will recover first, because then you've created 2 classes of units. It's only US people.
Yeah.
And so there's some limitations.
Yeah, that you would not have in a partnership taxation form, which is typically what you do with real estate. S corporations do have restrictions.
Yeah. Yes, sir.
Is there a benefit to being in an S corp, if not for the tax savings plus or minus, but for the contributions to Social Security and Medicare and those kinds of things? Because it matters as far as how long you're contributing to those, as far as.
Well, that's one of
that's
the key selling points of an S corp, Keith, is that you pay yourself a salary and pay payroll taxes on that, and then the rest of your earnings you don't pay payroll taxes on. If you want to you either leave them in a business or you take them out as a draw. Whereas if you're self-employed, you pay self-employment tax for both halves of the payroll taxes on everything you earn.
So you're still contributing to those funds?
You would still contribute,
Oh.
yes. Yeah, you could contribute for, I think at self-employment, once you've paid, all your Medicare and Social Security, you get to a point where you paid it all and you could not pay it anymore that year. But if you're self-employed, pretty much goes forever. But, you know, I think that this piece, this component has to sort of fit into a bigger plan that helps you like maximize your wealth. Not just the money you have, because you're gonna pay tax on that, right? Like, it helps you maximize your wealth, and pay fewer taxes. That's what we wanna do. And so the S corp might help you pay fewer taxes, but if you wanted to maximize your benefits, it might not fit that scheme. You would just wanna make sure you get like other tax savings somewhere else, I think. And so maybe you're contributing, you know, tons of money to like 401ks and retirement plans and IRAs. And,
Yeah,
you know, you're trying to, at that point, you probably don't want to be paying Social Security and Medicaid and Medicare because you probably won't need it.
that's an excellent point, though. If you are an S corporation and you want to make retirement contributions, those are based on what you pay yourself as a salary. So if you make a bunch of money, but you hardly pay anything to yourself on a W-2, the W-2 is what goes into the retirement calculations. So we're probably getting ahead of ourselves a little bit here, but you got to be careful of that. And that's where the whole reasonable compensation question comes in. I've had people say, well, I want to be an S corp. I shouldn't have to pay myself any salary. Yeah, anybody else get a little heartburn when that comes up? It's not the way it works. You're an employee of your S corporation. You do that long enough, the IRS will catch on. They've taken people to court over that and they've won every single time.
Yeah,
Don't
so
do like they did.
that's right. But I mean, I think, you know, so maybe you have a service company that's an S corp, and then you have, you've owned real estate that does like self-storage, and that should be a partnership. So you can take all those losses and accelerate depreciation. Maybe you accelerate depreciation, maybe you don't. It'll depend on like how much you're gonna sell it for, what the clawbacks look like on the sale. And so you wanna like make a strategy that sort of helps you minimize taxes, I think, but that actually fits your real life. Because if you put that self-storage unit in an S corp, you're limited to like losses of 3,000 a year or something.
Well, you could,
Well, plus
you have, you know, the basis limits are tougher to take losses against than they would be if you're not a corporate entity. There's things, you have basis in different things. Debt works better in a partnership than it does in an S corporation. And then, you know, there's appreciation of the asset that comes in if you're gonna sell. It really kind of comes down to bottom line. You have to look at what kind of business do you want to be in, and then figure out what's the best entity for that and do it on the front end. S corporations are great, but they're not always the best answer.
And how does it fit your personal 1040? You know, it should be part of a strategy. I think you can go to like Hewlett Packard, whatever the tax one is, like a Liberty Tax or whatever, but they're not going to give you a tax strategy that's going to sort of minimize taxes and like help you grow wealth over time. I think that's useful.
Yeah.
The C corp taxation, I think, is for a very specific thing. Everyone wanted to go to Delaware and be a C corp and raise a bunch of money. That's not really how it works anymore. Delaware laws changed a lot. It's not as friendly as it was. People go to Nevada or sometimes Wyoming, or there's some other ones, Utah maybe. But you know, the C corp is useful if you really are gonna have shareholders, or you're gonna have employees building this giant software project and you wanna give them percentages, lots of classes of stock. Maybe it's like a really risky thing. You're working on like nuclear reactors for Amazon as a consultant. You may wanna be a C corp. And just sort of isolate that liability more, get good insurance. But you know, generally we see that for much larger movements, I think. And I don't wanna hold anything in there, real estate or anything. Because the company's gonna pay tax, then when I get money, I'm gonna pay tax, and that just results in a lot of tax.
I've seen C corps work sometimes for, say, construction contractors, just because of some of the tax laws that they face and also bonding requirements. But oftentimes it's large entities with lots of investors, people that have designs on going public. A C corporation is the kind you can have any kind of shareholder you want. Obviously, you have to be legally structured in certain ways to do that. Sometimes you can benefit from having a second set of tax brackets at C corporates. That's gone away a lot with the law change that happened in 2018, where C corporations are taxed at a flat 21% versus 15 percent on the first little bit of income. But I'm not gonna say never use them, but I don't work with very many C corps. I can't say I don't work with any, but not that many anymore.
Yeah, I've seen real estate agents use them and then just take salary and move the income to zero. But I don't know why it has to be a C corp. You know, the part where we do use C corps is if you have a nonprofit that wants to, for example, own a pizza chain in town, they might do that with a nonprofit C corp.
Yeah.
And you would want to do that because you want to avoid the business income tax, the related business income tax, just in case you're operating for profit. If you get things out of a C corp for a nonprofit, you could do that via dividend. That's already exempted from the UBIT. So, you know, it does make sense just because of the structure, but it's kind of a specific purpose. We're not going to use it for a bunch of stuff. Any questions or thoughts on C corps, or anybody just really, really like them? Yeah, I mean, because we do use them. So there's other entities, cooperatives, nonprofits. We work with social purpose corporations. One is getting a fishing operation set up in Tonga in the Rising Deep Trench, which is pretty cool. Some other one is 3D printing homes, which is kind of fun, just like a 3D printing concrete mix that they developed. And so those guys are for profit. They could take money out of the company, which you couldn't do in a nonprofit. They could take money out for their own purpose, but they're also social purpose. So they apply for grants and try and get volunteers and all the random stuff, which is really, really interesting. And it depends on which state they're in too, and if it's a B Corp or public benefit, and if they're truly nonprofit or how they're classified. And then I had cooperatives usually are like housing associations or you know, food, like farm type organizations. I had it was a 12-unit duplex, and they were a cooperative, and they all got to vote and do all those kinds of things. But all of their work docs were for profit. They were registered as a for-profit. They had for-profit articles and bylaws, and they had all these for-profit docs. And I was really nervous about them filing. They were filing an 1120H, like they were a homeowner cooperative, and they were definitely not. And so, you know, getting those things organized is always really fun. And the owners were so mad. They thought we were trying to pull one over on them. And we were really just trying to make sure that they didn't have to pay a bunch of taxes on their last X years of income, because otherwise they did. And they were carrying income over in accounts and all kinds of stuff. So just a note, there are other entities out there. So this is something I wanted to ask Kyle about. I know we probably only have 5 minutes here, but when I'm working with businesses, a lot of times we talk about like this list of items and how we can get as close to possible to zero tax liability. Whether that's investing in real estate or, you know, buying vehicles isn't great. But there's research and development tax credits. And you could defer S Corp salary. I mean, do you have good strategies on how people should?
Well, yeah, I typically work with people case by case to find out what they've got going on and then look at what a strategy is. It doesn't make, sometimes you don't want to let the tax tail wag the dog and spend money on something that you don't really need just to reduce your tax liability. Also, you don't always want to get to zero because the lowest rates for individuals right now are 10% and 12%. In other words, they're really low. And as of right now, that's supposed to be good through 2025. We just elected a new president that says he wants to extend all of those because that was what he put in place when he was in office the first time. So finally, after the election, we're starting to get a little clarity on what tax laws are going to be like, but current law sunsets after 2025. So that has to be extended if it's going to continue. I take the approach with people a lot of times of, hey, let's pay income tax at those low rates every year because you can recognize a lot of income and not pay much taxes. But things like accelerated depreciation, I'm just going to go down the list you've got there. Accelerated depreciation. It used to be that the IRS would fight with people about saying, hey, why do you the game with depreciation, you write off the cost of something over the useful life of the asset. For books, you want to write it off as slow as you can. For taxes, you want to write it off as fast as you can. The IRS used to push back on that. Well, they don't anymore. Now they look at it as a carrot to get people to buy stuff. Hey, if you go buy this new equipment, stimulate the economy, we're gonna let you write it off in year one. What a deal. I always am careful with people, with S corporations where they do that and go borrow money, buy an asset, think they can write it off, and then suck the earnings out as a draw and get themselves in a hole. When people do that with things like cars, it can be real interesting. Vehicles, be careful there. There's what's called the luxury auto rules. I'm not gonna do a deep dive on that. But there are rules that restrict how quickly you can write cars off. A lot of people have gotten around those by buying big, heavy things that get around the weight restrictions. Pickups and things like Ford Excursions. I don't know if they still make those anymore, but they're big and heavy and they get around the luxury auto rules. That's why you see a lot of people driving Escalades and
6,000 pounds,
Suburbans
right?
to get over the 6,000 pounds. That's right.
Yeah.
Pass-through losses, you've got to look at, do you have tax basis to take the loss? You can lose your money, but not somebody else's money. That's fudged a little bit in the partnership arena, but not with S corporations. And then there's also passive activity rules. If you're in an entity and you're not actively participating, that's another hurdle you got to get over to deduct a loss. IRAs, similar to retirement plans, if you make a contribution, with an IRA, it's up until April 15th for the prior year. Other retirement plans, you can extend and accrue that deduction out even further, but you write that off in the year it relates to. We could do a whole presentation on different retirement plans. There's plenty of them out there. Section 179 deduction, there's also bonus depreciation factored in there. That's an election you make to accelerate the deduction for the cost of an asset. Very commonly done when somebody wants to get a write-off right now for something, for a business asset they want. QBI, sometimes it's called the freebie. 20% of net qualifying business income, subject to some restrictions, is just a straight write-off for business owners. It was almost too good to be true when we all saw it came along. Service businesses really have to watch it because you start making, you get into somebody like a lawyer that can start making hundreds of thousands of dollars. This can phase out entirely, and you have to really be careful of the definition of a service business versus an operating business. But this has been a very big deal for a lot of people. R&D tax credits, I have some people that claim those. That's a dollar for dollar credit, not a deduction against income.
Can I ask a question about that? Is it worth spooling up, creating something to take R&D credits? Like if I want to create my own place of service system to take payments, or, is it worth spooling that up?
It can be. That's a case by case thing. Typically when I've had people take R&D credits, they're doing something where the outcome is uncertain. That's a very general rule of it. But if you have something where you're doing some research where you're not necessarily billing for it right now, you can call it a credit expense and take a credit for it. Once you flip a switch and you put it in place, then it's not, the outcome's not uncertain anymore. That's a very general description of it. But there are some surprising things that qualify for R&D tax credits, and you can save some, you can get a very nice tax benefit for that.
So if I'm trying to create like a blueprint for a food truck, and I don't know if I'm gonna do it or not, or if it's gonna work out, is that
It's
R&D?
more whether it's gonna work out. You show me the plans and we'll talk about
Okay,
it.
or if I'm trying to create like a special brush for like a grooming or something, and I don't know if it's gonna work out or if I'm gonna be able to
It
patent
may.
it.
There's possibilities
So
there.
dollar for dollar is nice.
It is, yes, it is. And if you can't use that credit up front, they carry forward to future years. So there is a nice tax benefit there. And then S corp deferred salary, what are you talking about there?
Just, that you can elect S corp, but you could defer salary until a later year. You still have to pay employment taxes and all those things. But really, my point there is that, if you're getting all of this stuff set up, it doesn't have to be set up in the first month. But if you can get it set up in the tax year, I think that's really where it counts. Even if it's, December, the next 40 days, right? That's where it really counts.
Yeah.
So I think, this is my last one and then I will be done. I promise, Paul. So the one that I've been really excited at is in Seattle, for some reason, not necessarily as much in Ballard, but in Seattle, people are adding a bunch of locations for coffee shops and breweries and restaurants, which I think is really bizarre based on the current margins and things. But some of those areas have really exploded. And so they're adding separate locations. And so I think, at least on this slide, to me, the issue is, do I want to add a separate location or do I want to create a separate entity? And I think that's a hard question, but if you're just adding a little bit of income, maybe it's a short-term lease, it's the same business, line of business, exactly the same line of business. I think you can just go add another location, or add another food truck. The issue is, the more stuff you put in one bucket, the more stuff someone can take out of it. So if you have a 12-plex, and you're gonna go buy another 12-plex, maybe it's in a different state, I might separate those. Maybe if there's retail on the bottom, if there's separate like insurance portfolios, I would definitely separate those. Just because you want your assets to be to some extent as independent as possible. So that if somebody, takes down your self-storage, or some slip and fall thing, then your restaurant's still operating. You still have a line of income. It's not all in one thing. If you're trying to insure a restaurant self-storage facility, I think your insurance portfolio is going to be much higher than insuring each independently. So I think I talk a lot about, if it's going to be just a separate location or if it really should be a separate LLC altogether. Maybe there's separate owners. Maybe a new investor wants to come to a new location and then you want to set that LLC up separately so you can just give equity in that LLC instead of maybe all of your LLCs, or maybe it is all of them. And so that takes a lot of planning, I think. We do some foreign entity registration from people fleeing from California and into other states. We get to work with like some franchise folks, which
I
is.
saw somebody ducking over there.
No, I agree.
Recovering Californians?
And then, the last thing I promise that I want to talk about is protecting your key people. And if you do have key people who are doing all of your financials and taking care of all of your stuff, making sure there's a succession plan there. Like, yeah, estate plan is really nice, power of attorney, all that stuff is really great. But like on your MacBook, go and designate a beneficiary. Like take practical steps to make sure everybody has that information. Because I was talking to Kyle, I saw Scott from Ethos on Friday. We were having happy hour. And on Saturday, he went to a wedding. And on Sunday, he died. That was it. You just don't get to talk to Scott anymore. Nobody had any of the information. Nobody could do anything. And he was gonna go get an estate plan that was on his list for a long time. And it was just one of those things, And so now I think we're gonna pay Kyle a lot of money to pick up the pieces. And we're just gonna figure out all the debts and work on that. But, it happens really fast. So just make sure you have a plan in place. I think it's useful personally, business-wise, all of those things, just in case. So
We'll take some questions, but keep that slide up there just in case we don't have a lot of questions, but one from from Zoom. If a C Corp tax rates drop below 21%, would it be better to consider that entity structure instead of an S Corp? If it were to drop below 21?
Whether it's better or not, I'll give you the classic tax answer, it depends. But if the C Corp rates drop, I'm not crossing my fingers, but if they drop, then yeah, you'd want to certainly take a look at it. maybe it makes sense to go to an S corporation. There's hoops you gotta do to go through. If a C corporation becomes an S corporation, it can be done. But it's a planning opportunity. I'll just leave it at that.
I think that is definitely worth considering. You're taking, let's say you take money out of the C Corp at 18% as a dividend maybe, and you're still paying capital gains tax on that too.
Yeah, the issue with getting money out of a C corporation, if it's not a salary, if you take it out as a dividend, it's not a deduction to the C corporation and it's
Yeah.
income to the shareholder. Now, those dividends are usually taxed at capital gains rates now, so less than ordinary. It's not the it used to be, but that's where you hear the term C corporations having double tax. And that's historically been the issue with C corporations. S corporations get around that. But there are ways. It's a case by case thing. Everybody's tax and life is a little different.
Thank you. Yeah, so I mean, I have worked with real estate agents who use a C Corp and just take all the money out in salary, so the C Corp has no income at the end. I don't understand why, but they like C Corps. They're from the 1960s.
Other questions?
We got one in the back.
If you are attempting to sell an S corp, how do you establish the cost basis of it when you get the sale completed to figure out what your gain is for tax basis?
You keep really good records is how you do it, because cost basis on an S corporation is a moving target. As it earns money, your basis goes up. As it loses money or you take distributions out, your basis goes down. So your basis, it's not what you originally invested.
So it's not the inception value? Oh,
Possible, it's not even close to that.
huh.
So, so if you have somebody who has had an S corporation interest for a long period of time, and the basis hasn't been tracked, it can be, you have to go figure out what their investment was, get their K1s. And it can be done, but it's a lot of work.
So the basis is based on the annual P&L report?
On whatever's on your K1.
Oh, okay, okay, what? Thank you.
Question.
Yeah. it is.
You know, there's another thing with an S Corp that I've always wanted to do, where you could sell just the membership of an S corporation, but treat it like it's an asset sale and still get depreciation on the buyer side, like the 338H10 election. And everybody puts that in their contract and we all get to right before closing and then nobody wants to do it. And I wanted to do it for a really long time. So if you guys have any S Corp sales, let me know.
I had that come up on a sale. Oh gosh, it was earlier this year. I got involved in a sale and the buyer really wanted that tax election because they wanted the step up in basis on the assets so they could depreciate them. Well, when you make that election, the seller pays tax as if they sold the assets. So that's getting into the weeds quite a bit. You know, if you're gonna sell an S corporation, come talk to us, we'll help you out. But, it sounds great on paper, but there's a little more to it.
Yeah, it does sound great.
Which side of the deal you're on?
Yeah, that's right. Well, I'm always on the seller's side, which is unfortunate.
Are distributions an advantage of S Corp shareholders?
Sorry, what was that?
Aren't distributions an advantage of S Corp shareholders?
Yes, they are. You know, you're taking a distribution of S corporation earnings. And the advantage is you take it out, you still pay income taxes on it, but you're not paying payroll taxes on it. That's one of the key benefits of an S corporation.
Thank you. The questions?
And will that reduce your basis? Get that tax-free rate return here.
Yeah, well, you already paid tax on it on your K1, whether you leave it in or take it out, but a distribution does reduce your basis.
Couple questions. When you were talking about 1099 versus employee, how does that relate to? I know California did some work on this, but the Uber driver thing where there really isn't home base, but you're, working your tail off. But you don't necessarily have a business license either. You just open the app and go pull the ride. So you're neither an
Yeah.
operating business or a 1099 by definition, by what you said.
I think you're exactly right, honestly, is that it's definitely in the gray area.
Oh,
Because on the, if you just Google the LNI 6 or 7 part test, you have to meet it, all 6 factors. Unless you meet the personal labor test, which they don't in that case, because the equipment's being provided for them and they're getting told their routes and all those kinds of things. Then they have to meet that test and they don't. So they have to go have a business license.
is that the
Yeah,
case?
yeah, and so, and that's why I think when people file those kinds of lawsuits, Uber either settles or loses. Because it's really sort of in the middle. They've tried a lot more to shore that up and make it more like a gig economy type stuff and make sure that they require business licenses and submission of insurance and all those kinds of things, but it's definitely not perfect. So that is a hard one.
And then, I'm sorry.
Oh, no, I was just gonna, the last thing is nothing is stopping you from misclassifying or Uber from misclassifying a contractor, right? They can live with that as long as they want to, but it's just when they file. And that's the issue, is no one's auditing that relationship unless it's filed. Attorney General or anything.
So when, in your opinion, if somebody's an S corp, over here, and you're deciding to expand, is there a rule of thumb to decide now's the moment to move into an LLC? If that, in our case, we had at 1.2 locations and a food truck. So that's a lot of moving parts, employees, liabilities, but never really got any direction as to why fix what's not broken. S corp's been working fine. But a lot of opinions, oh geez, LLC, what's the matter with you, They can take your eggs and your nest,
So okay, I'll defer to you guys, but just the first note is that to make an S corp election, you have to have an entity, whether it's a C corp with the state that you filed, or an LLC with the state that you filed, or something. You have to have some kind of entity. So I'm almost certain that if I looked you up on the Washington Secretary of State, that you're likely an LLC that has made an election as an S corp. And so that may limit your losses, and maybe that's where people are saying, why aren't you wholly disregarded? What do you guys think? Is that fair?
I didn't really understand.
No, I think
an operating restaurant as maybe I said C corp, I meant to say
S-corp.
S corp. Oh, yeah,
Okay.
yeah,
as an S corp.
but I imagine that your S corp is likely formed as an
Yeah,
LLC.
are you legally a Washington LLC
I bet so.
or maybe a Washington corporation?
No, I think it's an LLC.
I'm the dummy making tacos. But
Well,
I think
Probably.
it's just an S corporation. On our tax return,
Sure.
I'm a salaried employee, interestingly enough, at a $60,000 salary. But with a profitable restaurant, like I said, we're closing, so. But with a profitable restaurant, there were, at times, profits in excess of $100,000 a year. So all of those flowed through, to use the S corp lingo.
Yeah,
I think you're doing it right.
What?
I think you're doing it right.
But then you go to open a second location, now all of a sudden is our liability, is our risk higher now? We've got 2 locations and we've got a food truck. We've got a food truck driving over here. We've got different vendors that we're stocking up here. Now do I need to be an LLC? Or what would stop me from being,
I think you still are an LLC
Oh,
being taxed as an S corporation. And I think I've looked you up before a long time ago. And I think you're an LLC. And then you made the election with the IRS for the S corp taxation. But in your case, I would probably make those locations at this point, because for a couple of reasons. Adding LLC is gonna add administrative burden, you're gonna have to aggregate all your taxes. But also, you might be looking to franchise and you would want like some of the key financials to come from within like your franchisor organization or whatever. And so then you would say, look, here's the three. Doesn't have to be owned by random people. It's just tumbleweeds. And so you could produce those financials when you go franchise. So then that could be like your base operating entity. Maybe if you have a bunch of other entities in other states, you can do a new one. You can form a franchisor entity, but you know, at 3 locations, I think you're okay at this point. But if you're gonna do another location with like another 50% owner, easy LLC.
Oh, okay.
But then you're doing like the employment filings again, Department of Health again, and so like you have to decide when that's worth it. That's the goal, yeah, that's the hard part. Good questions.
Josh, you mentioned employee handbook, importance, documentation, a PIP, performance improvement plan, documentation. What else have you seen gotten companies in trouble when they didn't have good documentation?
Oh, man. Well, I think the worst part, so definitely having like documentation is good. Having an offer letter, even if it's just an employee, having an offer letter is good. I don't like to do employment agreements because that makes it look like there's an agreement between us and we can't terminate it. So maybe that's messing with at will. And so I like the offer letter side. I like the, you know, at will side. If you're gonna do like a full agreement, then let's just make it a term for 2 years. You can't quit and I can't fire you unless you do something really bad. And so then, you know, usually that comes with like confidentiality, even the offer letter, and like ownership. You know, so long as you're like not a doctor or something where it's like a regulated professional, making sure that when your employees do stuff for you, that you own it. I like that a lot. Cause I come down, you know, you publish something useful and then they see it on Facebook as an advertisement. They're like, oh yeah, I actually did that. I own all of that. I'm gonna sue this guy. Now he has money. And so if you can just be like, oh no, you signed this, no problem, then it's done. You know, and I like to do those kinds of things. You know, I think the part that I don't like, I have spoken with some folks in the past who will talk to me for a little bit and then they'll go and like give away equity to a bunch of random people, like by email and all kinds of things. That's not good. You have to be focused and dedicated, and if we're gonna do it, let's write it down and like have everybody sign it. But if you come to me and you've like made 50 steps in the middle, it's hard to like go reconcile those things. So, you know, I think if you're gonna go like do some serial entrepreneurial stuff, let's go do it. But you know, don't remake the wheel. Yeah.
Do you evaluate employee handbooks to its legality? Is that part of your, or do you know other attorneys in town that do that?
Yeah, yes, I do, and in Seattle as well. And so there's a couple of things now that, you know, all the states are different. So the handbooks are different. Some states require like voting rules. Everyone's got different jury leave, military stuff. And so you have to look to the rules in each state. And you have to do that now for like online terms of use and privacy policies too, because all the states have little mini GDPRs that are coming on, like the European side, where you have the right to like delete your data or modify your data or transfer your data or get a copy of it. So, you know, I think like making sure all the online stuff is up to date has been really hard too. It's changing so much. So it's changing a lot. And you know, if you go ask AI for something and they create something for you, do you own it? You know, not really. So that's its own separate like struggle at this point. So, yeah, Copilot's great, but it's not like a work for hire. So.
Can you go back to your last slide of, you had trademarks? Trademarks and payroll management, those ones you didn't get to. Can you hit those real quick?
Yeah, so the trademark thing, people get big letters all the time about trademark infringement or registering their trademark, but this actually is legitimate. And I always say, if you're gonna go spend time and money on building a brand, then let's go trademark it. If you're not gonna trademark it, at least use the little like TM. But you know, it's not that expensive to go file with the USPTO and say, this is my use, and get the circle R. And I think it's useful because a lot of brands are coming from Canada now and they're sending my clients all these random letters, but they haven't actually like done the trademark process. So if you don't know, like, hey, you don't have a serial number, you guys didn't file, this is a made up letter. It's real, and they're demanding cease and desist stuff, and, so that definitely, like, having a brand, I think, is gotten important. Yeah, I think that is important. So the other thing is really just like the affordable benefits, like the HRAs and stuff. I think a lot of the small businesses, I mean, you can't go give like marketplace insurance and like a giant retirement with like 6% matching if you're just starting out, but there are other options, you know, to give people a little bit, to reimburse some health bill, like health expenses. And so to just like keep employees, I think, attracted to that role. Finding labor alone is really hard.
Whenever I see the words affordable benefit, I think it's an oxymoron. I hate to say it.
Yeah, you're gonna pay for it. But I also think that you pay for high employee turnover.
Yes, you do.
Yeah.
So balancing those is really hard.
Mhm. Absolutely true.
So,
All right, let's thank our experts. Again, they'll stick around afterward if you'd like to access their services. The slides will be emailed to you if you registered, either online, or if you're here today. And the video will be on YouTube if there's someone you'd like to refer this information to. Again, thank you STCU for sponsoring Ask the Experts, making it free to participate. Josh has generously donated 2 $100 gift cards to Target for you that stayed today. So here we go. No, Kyle, put that away.
I was playing Vanna for you.
All right, come on up here, Sarah. Let's do a drawing. $100 just in time.
Oh, no, here, sir.
Just in time for Christmas. You know. Zoom folks, sorry, you gotta be here to win.
That's all right.
Would you do us a favor and fill out the evaluation form? And you can just leave it turned over at your table. If you're on Zoom, the QR code is on the screen here. If you mind scanning that and sending that in, we want to make this, of course, most beneficial. All right, let's find out who our winners are. Just in time for Christmas. $100 gift card to Alan. Woohoo! All right. And
I also had the resources list back there.
oh yes, Josh also has a resources list on the back. So thank you for making that. I appreciate that. And Sammy, the Target. You're going to Target. Our next Ask the Experts is the third Tuesday of the month at 3, December 17th. And we've got a powerhouse lineup for the Case for Servant Leadership. We've got Michelle Holt from the Benton Franklin Council of Governments, Dr. Shannon Marie from Columbia Basin Hearing Center, and Brian Newberry, the CEO of Girl Scouts Eastern Washington. So talking about why that is the best form of leadership, sorry, my opinion, to my personal mission statement. So for leading your company or at whatever level, your leadership in your organization. So we hope we'll see you for that. May your business continue to prosper as you hit the home stretch of 2024. Thanks again for coming.